When making a decision to move from one MedMal insurer to another, medical practitioners need to understand the core difference between an occurrence and a claims-made insurance policy. Making sure there are no gaps in cover is easy if you know what to look for. Your broker is there to advise and help you. The core difference is essentially which insurer will be responsible for a claim and when. Either your old insurer or your new insurer should be responsible for your claim, and that will become clear when you understand the difference between the two policy types. Both policy types will, if structured correctly, cover you for all your insured MedMal. It really just boils down to price. With an occurrence-based policy, your insurer at the time the medical procedure or occurrence that gave rise to the claim took place must cover your MedMal claim. With a claims-made policy, your insurer at the time the claim is brought against you must cover your MedMal claim. If we were to look at how an occurrence policy works in practice, we would see that if a practitioner was insured with Insurer A between 2015 and 2019 and then becomes aware of a potential claim in 2020, when they are now insured with Insurer B on either an occurrence or claims-made basis, then Insurer A would be responsible for the claim, as it received the premium in the year when the negligence occurred. If we were to look at how a claims-made policy works, then we would see that if a practitioner is insured on a claims-made basis with Insurer A between 2015 and 2019 and then becomes aware of a potential claim in 2020 when he or she is now insured on a claims-made basis with Insurer B, then, provided that Insurer B offered a retroactive date of 2015, Insurer B will be responsible for the claim. So where can the gaps in cover arise? Well, 1. If you move to an occurrence-based policy, the new insurer will only pay claims that arise from medical procedures that are performed after inception of the new policy. Therefore, under the new occurrence-based policy, you will not be covered for procedures performed historically. If you were previously covered by a claims-made policy, you would then have to ensure your previous policy has run-off cover for all your old procedures not covered by the occurrence-based policy. This, along with the fact that cover will not be backdated by means of a retroactive date, are two shortcomings of an occurrence-based policy and result in you being tied to the same insurer, whether they are still around or not, for life. Genoa has an easy solution to this, but more about that later. For now, just remember ERP. If you move to a claims-made policy, the new insurer will pay for claims that are brought against you during the new policy period, even if the procedure that gave rise to the claim was performed prior to the inception of the new claims-made policy. This is subject to you and your insurer agreeing to how far back you want to go and deciding on what's called the retroactive date. Worldwide, there has been a market trend towards offering medical malpractice insurance on a claims-made basis because it is seen as a more modern approach and, when structured correctly, is more cost-effective. 2. There is no point in paying additional premium to cover such historical procedures if you moved from an occurrence basis, as those claims will continue to be covered by your previous insurer. This is one of the advantages of a claims-made policy, and moving from an occurrence basis to a claims-made basis does not create any gaps in cover and is easy and risk-free. 3. Although an occurrence-based policy has its shortcomings and gaps in cover prior to the inception of the policy, its biggest advantage is that when you retire or cease to practice and your policy is cancelled, an occurrence-based policy continues to cover the procedures that you performed during the policy period for a very long time. However, the liability to the insurer continues well beyond your death, and therefore well beyond your liability term. You might therefore be paying for cover you don't need. 4. Although a claims-made basis has an advantage prior to inception of the policy with a retroactive cover, its only potential weakness would be that once the policy is cancelled, it requires some sort of run-off cover. Genoa has a simple and effective solution by providing an extended reporting period, or ERP. This allows the practitioner to continue to report claims after cancellation of the policy when you cease to practice. The Genoa product automatically provides up to 5 years of ERP, but additional ERP or AERP can be purchased on an annual basis thereafter if necessary. Annual ERP is currently available at premium rates that vary between just 15% and 20% of the annual MedMal rates. So, at current rates, an additional 5 years of ERP over and above the automatic 5 years would only cost you 1 additional year's premium. This gives the practitioner the choice to decide on how long to extend the cover, and is in fact seen by us as the claims-made policy's biggest advantage over the occurrence-based policy. In summary, before inception, a claims-made policy can provide cover for procedures performed before the policy incepts, which an occurrence-based policy doesn't. During the policy period, there is no material difference between the two policy types during the policy period, as both will cover all procedures performed and claims made during this period. After policy cancellation, when you cease to practice. For a lot more premium, an occurrence-based policy will provide cover for a very, very long time, which could be well beyond your term of legal liability. Whereas a claims-made policy gives you better flexibility to only buy cover you think you need, which will very much depend on your medical discipline and type of practice, and save you premium. Please note that the premiums for the additional ERP extension are merely indicative rates used for illustrative and pricing comparisons, and as such are subject to change in line with claims and other market trends. Terms and conditions apply. Genoa Underwriting Managers. Innovative insurance solutions.